At 5:12 in the morning on April 18, 1906, the city of San Francisco shook itself apart. In less than a minute, entire city blocks collapsed, gas mains ruptured, and the richest city west of Chicago went up in flames. But what followed wasn't just a disaster of stone and fire. It was a financial earthquake that nearly toppled the entire global insurance industry. Because the story of the 1906 San Francisco earthquake isn't just about tectonic plates or tragedy, it's about how one natural disaster exposed the fragile web of international finance connecting London, New York, and San Francisco, and almost brought it all crashing down. Before the quake, San Francisco was booming. It was the crown jewel of the American West, a city of gold rush millionaires, shipping magnates, and rail tycoons. By 1906, it had over 400,000 residents, and its skyline was filled with grand hotels, ornate banks, and the famous mansions of Nob Hill. Real estate prices had soared, and with them, insurance policies. Fire insurance, in particular, was big business. Dozens of companies, British, American, and European, competed fiercely to insure the city's valuable buildings. But there was a hidden problem. They had no real idea how risky San Francisco truly was. The city sits directly on the San Andreas Fault, one of the most active seismic zones on Earth. Yet earthquake science was still in its infancy. Insurance companies priced their policies as if the only risk was fire, not the ground itself moving beneath the city. And in a strange way, they were right, because when the quake struck, most of the damage came afterward, from the fires. The shaking itself lasted less than a minute, but in that time, it ruptured gas lines, broke water mains, and ignited over 30 separate fires that quickly merged into a sea of flames. For 3 agonizing days, the city burned uncontrollably. Entire districts simply vanished. When the smoke finally cleared, over 28,000 buildings were gone. More than 80% of the city had been destroyed. The total loss was staggering, around $500 million in 1906 dollars, which is more than $15 billion today. But the real shockwave was felt when insurance companies started counting their losses. You see, their fire insurance policies didn't technically cover earthquakes. They only covered fires. Insurers quickly realized that if they could classify the destruction as earthquake damage, they wouldn't have to pay a dime. And that's where the chaos truly began. Businesses argued their properties burned down after the quake, not because of it. Insurers countered that the quake caused the fires, so it was an excluded event. Thousands of lawsuits erupted. The British firms, which dominated the global insurance market at the time, were hit the hardest. They had written massive policies on San Francisco's most valuable properties. Companies like Royal Insurance in Liverpool and London and Globe faced claims that dwarfed their entire capital. And it wasn't just a few companies. Nearly 90 insurance firms operated in San Francisco. After the disaster, 20 of them went bankrupt outright. It was financial contagion, long before we even had a word for it. Insurance was the invisible backbone of global finance. Policies written in San Francisco were backed by reinsurance agreements in London, Hamburg, and Paris. When one company collapsed, its obligations rippled outward, threatening to take down others with it. For the very first time, the world saw just how interconnected financial risk had become. One name, in particular, stood on the brink: Lloyd's of London. Lloyd's wasn't a single company, but a market, a network of individual underwriters who each took on a share of global risk, backing it with their personal wealth. The quake pushed Lloyd's to its absolute limit. Many of its names, the wealthy individuals who guaranteed policies, faced complete financial ruin. In total, British insurers owed over $200 million in claims. Some were simply unable to pay, but others, fearing the total destruction of their reputation, made a historic choice. They would pay everything, even claims they could have legally denied. This was an extraordinary act of financial self-preservation. The chairman of the Liverpool and London and Globe Company famously declared, "We will pay every penny, not because we must, but because we should." That single decision saved the global insurance system. Had the major British firms defaulted, confidence in insurance, and by extension, in all of global trade, might have collapsed entirely. Because insurance wasn't just about buildings. It underpinned shipping, banking, and international investment. If insurers couldn't be trusted to pay, global commerce itself would grind to a halt. So London paid. And the city of London, as the world's financial center, absorbed the shock. But it came at an immense cost. To meet their obligations, insurers had to liquidate assets all across Europe. They sold stocks, bonds, and gold reserves. This sudden outflow of capital caused what some economists now call the first modern global liquidity crunch. Even the Bank of England was forced to step in, a move that foreshadowed what central banks still do today in times of crisis. The ripple effects even reached New York. American insurers with smaller reserves scrambled to raise cash. It was one of the first times the US and British financial systems had to coordinate in response to a shared disaster. In a way, this 1906 earthquake was the first truly global financial crisis of the 20th century, not caused by speculation, but by nature itself. And like every crisis since, it exposed two fundamental truths. Risk doesn't just disappear, it just moves around. And it's confidence, not capital, that truly keeps the system standing. But there is another incredible twist to this story, one that links directly to the major financial panic of 1907. As British insurers drained gold reserves to pay San Francisco claims, the global money supply tightened. Gold flowed out of London and into the United States to fund reconstruction. That drain made global banks far more vulnerable to shocks. So when a credit squeeze hit New York in 1907, the lack of liquidity turned it into a full-blown panic. Some historians argue that the San Francisco earthquake indirectly caused the panic of 1907, which in turn led to the creation of the U.S. Federal Reserve System. In other words, a quake in California helped give birth to modern central banking. For San Franciscans, insurance payouts became lifelines. Companies that paid promptly were hailed as heroes. Those that denied claims were vilified and driven out of business. Many survivors said the only reason San Francisco rebuilt so quickly, rising from the ashes in less than a decade, was because of the insurance money that did come through. The crisis also changed how insurance was structured globally. Before the quake, reinsurance was an informal network of gentlemen's agreements. Afterward, it became institutionalized, with formal treaties, clearer definitions of risk, and the rise of specialized reinsurers. It helped shape our modern idea of systemic risk, the understanding that one local event can ripple through the entire financial system. The insurance industry learned the same lesson that banks would learn a century later in 2008. Confidence is contagious, and so is collapse. But perhaps the most interesting parallel is happening right now. In recent years, climate disasters have grown more frequent and far more expensive. Hurricanes, wildfires, and floods now cause annual damages in the hundreds of billions of dollars. The insurance industry once again finds itself stretched thin, just as it was in 1906. Major reinsurers have warned that the current trajectory of climate-related losses is simply unsustainable. In places like California and Florida, we're already seeing major insurers withdraw entirely. It is the same dynamic. A system built on confidence is facing shocks it can fully model or predict. The 1906 earthquake showed us how quickly that confidence can crack. The global insurance industry survived, but only because it sacrificed enormous wealth to preserve trust. Would today's markets do the same? When disaster strikes now, the players aren't wealthy underwriters in London, but algorithmic reinsurers, hedge funds, and state-backed catastrophe bonds. Their loyalty isn't to reputation, it's to returns. If a modern version of 1906 happened, say a $1 trillion disaster hitting multiple cities at once, would our financial system hold? Or would it fracture under the weight of its own complexity? That's the unspoken lesson of the San Francisco earthquake. It wasn't just a test of buildings, it was a test of promises. And over a century later, in an age of rising global risks, it reminds us that finance, like civilization itself, stands on shaky ground. Thanks so much for watching. If you found this story as fascinating as I did, please consider liking this video and subscribing for more deep dives into the events that shaped our world. See you in the next one.